Hello, this is a PowerPoint presentation by the Office of the State Comptroller, Retirement Services Division. This presentation is for Tier 1, Tier 2, and Tier 2A members who have completed 20 years of hazardous duty service and will be retiring under hazardous duty retirement before July 1st of 2022. This video is designed to help answer the main questions members would have regarding the retirement process. The goal of this video is to provide the same information in this setting that we used to provide in our traditional counseling sessions. This is not meant to cover every retirement provision or detail, but rather is a general explanation of the most important retirement issues and considerations. During this presentation, we're going to talk about the retirement benefit calculation. We're going to discuss survivor options. We're going to talk about the retirement process, and we'll have a conversation about health insurance. Let's draw attention to the retirement benefit calculation. First, you must have met the minimum hazardous duty service requirement to qualify for hazardous duty retirement. The minimum hazardous duty requirement is to have worked 20 years in hazardous duty positions. If you have met that requirement and retire, your retirement benefit will be calculated based on a formula that uses your service credit and your average salary. We'll be discussing how we calculate those over the next few slides. Let's talk about how we calculate your service credit. Service credit includes all periods of state service for where you paid retirement contributions. If you're out on workers' comp and the workers' comp you received was for lost wages, that also counts as service credit. If you were in a job classification that allowed you to take advantage of a voluntary schedule reduction program, after June 9, 1994, as long as it's properly documented as voluntary leave, we would give you credit for those days as well. Same thing would count for furlough days. If you had furlough days in the past, we pretend you worked those days, they do not count against you. Now, after you've satisfied your 20-year hazardous duty requirement, there may be additional service that would count towards the monetary calculation of your benefit. One of those would be your vacation balance. When you retire, if you still have vacation time left on the books, you would be paid for it, and that counts as additional retirement service. Some of you may have also gone through the process of purchasing additional service. The most common one we see is prior military service. Excluded from your service credit would be any unpurchased leave of absence without pay, and workers' comp that you receive not for lost wages, but for a specific indemnity award, also called permanency payments. Those are payments that you receive as a reward for the injury. They do not count for retirement purposes. For those of you who had part-time service, let's talk about how we calculate that for retirement purposes. First, when we're determining your eligibility to retire, we ignore the part-time schedule that you worked. We're looking at the date-to-date service that you were employed to determine your eligibility to retire. However, when we calculate what your monetary benefit will be, we're going to adjust your service credit total to reflect the schedule that you worked. Let me give you an example. Say you're an employee that's worked for 20 years in a hazardous duty position and have worked 50% time over the course of your career. For determining your eligibility to retire, we're going to look at the 20 years that you've been employed, date-to-date service, making sure that they're in hazardous duty positions to satisfy the hazardous duty requirement. However, when we calculate what your monetary benefit will be, we're going to shrink your service credit to a total that reflects the schedule that you actually worked. If you worked 50% of a 20-year schedule, we'd be using 10 years, which is 50% of 20, to calculate the monetary benefit. On this slide, we wanted to show you the math that is used to come up with your benefit. As you can see in this illustration, my example has 21 years and 3 months of hazardous duty credited service. First, we take the total hazardous duty credited service to a maximum of 20 years and multiply it by 2.5%. This is where we get 50% to use in our formula. Since my example has over 20 years of credited service, any additional service, both hazardous duty after the 20 years and any non-hazardous duty credited service, will get included in the formula as well. We give credit for years and full months of service. My example has 1 year and 3 months of additional service. As you can see on this chart, 3 months is the equivalent of a quarter of a year. So for my example, we take the additional 1.25 years of credited service, multiply it by 2%, and add these two answers to come up with the final benefit percentage. As illustrated in my example, this member is entitled to 52.5% of his or her average salary. The next important factor we use in the benefit calculation is called your final average salary, or FAE for short. When we calculate your average salary, we're looking for any 3 periods of 12 consecutive months that make up your highest earnings. They don't necessarily have to be your last 3 years. They don't necessarily have to be consecutive or calendar years. They just have to be 12-month blocks, 3 different times during your career that are higher than any other calculations that we can come up with. Now, it's important to note that there are some limitations we must take into consideration when we calculate your average salary. Some of these limitations are actually a little complex to explain in this brief summary. You can actually find more detailed information on these topics on our website. The first limitation I would like to explain is called the 130% cap. What that means is that when we identify each of your 12-month blocks, that answer cannot exceed 130% of the average of the 2 years that came before it. If that answer is more than 130% of that average, we would have to cap that 12-month block. This typically happens if someone has recently had a large promotion or dual employment during that 12-month block we want to use for your average salary. It's important to note that when we're calculating the 130% cap, we have to ignore overtime. So if this 12-month block is higher than the 2 years that came before it, and that was because this 12-month block has more overtime in it, we ignore overtime when we're determining the 130% cap. The next cap we have to measure is called the 150% cap, which became effective in July of 2014 as part of the 2011 CBAC agreement. This works very similar to the 130% cap, except it is measuring overtime. That is, that when we determine each of your 12-month blocks, that answer cannot exceed 150% of the 2 years that came before it when we include overtime. Last, each 12-month block is also limited to the IRS compensation limit. The IRS has a compensation limit for each calendar year. For example, in 2018, that was $275,000. In 2020, that is $285,000. And what this means is that if you are a high wage earner and that 12-month block exceeds either $275,000 or $285,000 or some number in between, depending on the year that we're looking at, you'd be limited to that amount. Going back to the formula we used for the pension calculation, we take the benefit percentage and multiply it by the average salary. The resulting figure represents the yearly benefit. And when we take that figure and divide it by 12, we would get the monthly benefit. If you are transitioning directly into retirement, you'll be entitled to one cost of living increase each year. This COLA is going to be paid either January 1st or July 1st, and is all based on when you retire. As long as you're retiring before July 1st of 2022, the COLA will range between 2% to a maximum of 7.5%. It's all based on a formula that takes into account inflation and takes into consideration changes in the Consumer Price Index for urban wage earners. You must be retired at least 9 months to qualify for your first COLA. Here's an example of when a member's COLA anniversary would be. For this example, I used retirement dates between May of 2020 and April of 2021. But basically, as you can see, if your retirement date is between May and October, your first cost of living increase will be in July of the following year. Alternatively, if you retire between November and April, then your COLA will not be July, but rather it will be the first January that occurs after you've been retired at least 9 months. The next topic we're going to discuss is survivor options. After making the important decision that you want to retire, the next most important decision you'll be deciding on is which survivor option you wish to take. When you complete retirement paperwork with your agency, you'll have to choose one of the following 4 different survivor options. There are 3 important things to keep in mind when completing this paperwork. First, once you elect a survivor option, it is irrevocable. It can never be changed in the future. If you elect a survivor option that will continue to be paid to someone after your death, that election is irrevocable. Under no circumstances can this be changed. For example, if you elect a survivor option for someone and later in life that person passes away before you do, or you go your separate ways, such as divorce them, they still retain a right to your benefit. You can never take them off, and you can never replace them with someone else. Your option can never be changed after you retire. Second, if you qualify for retiree health insurance, as long as the retiree are alive, you'll be able to continue to provide health insurance to your eligible dependents. And when I say eligible dependents, please note that retirees follow the same rules as active employees when it comes to who can be on your health insurance. However, it's important to note that health insurance is tied to a payment. As long as there's a retirement payment being made, health insurance can be paid too as long as health eligibility rules continue to be met. But if you elect a survivor option that has money stop at your death or after a fixed period of time, then the health insurance payments will end too. We will cover this more as we go through the different options. And third, as we discuss these options, I want to remind you that you, the retiree, will get paid for as long as you are alive. Some of these options have time periods that apply to them. It's important to remember that a time period doesn't apply to you, the retiree. The entire discussion we're going to have is how your choice affects your survivors. Again, the retiree gets a benefit for their life regardless of the option they elect. We'll make this more clearer as we go through each of the survivor option choices. I wanted to use a slide to illustrate how a retiree's benefit would be adjusted under each of the different survivor options. When we calculate the survivor options, we use the age you, the retiree, are closest to at the time you retire and the age that the optionee is closest to when you retire. Your individual numbers will be different than my illustration because for this illustration, we're using a retiree that's closest to age 50 and an optionee that is closest to age 58 with an assumption that the retiree's straight life annuity benefit is $4,270 a month. We're going to cover each of the survivor options and refer back to this slide to illustrate how this retiree's benefit would be adjusted. The first option we're going to discuss is called the straight life annuity option, or option D. This is the option that provides you with your full benefit, but makes no provision to pay benefits after your death. Under this option, you'd receive the maximum benefit, but at the time of your death, all payments would stop, including any health insurance for any eligible dependents that were on your health insurance at the time of your death. Since you have made retirement contributions to the pension plan, if there was still money credited to your account at the time of your death, whomever you identified as a beneficiary to receive a refund would receive a one lump sum payment in lieu of any additional payments from our plan. Last, any health insurance eligible dependents would be offered health insurance through COBRA at full cost and is currently limited to 3 years. Looking back at our illustration of the survivor options, here's where you identify the straight life annuity option. The next option we're going to discuss is option A, the 50% spouse option. Unless you're providing a benefit that continues payments to your spouse after your death for the rest of their lifetime, unless we have a signed waiver or acknowledgement from your spouse that they're agreeing to waive their right to a lifetime benefit, it's important to note that plan provisions require we implement this 50% option for your current spouse. This applies to a current spouse at the time of retirement that you've been married to for at least a year. Under the 50% spouse option, your benefit would be permanently reduced. The amount of the reduction is based on the age you are closest to and your age your spouse is closest to when you retire. You, the retiree, would receive the reduced benefit for your entire lifetime. At the time of your death. If your spouse is still alive, your spouse would start receiving half of your benefit for the rest of their life. As long as you qualified for retiree health insurance, as long as you were alive, you were able to continue health insurance to your eligible dependents. At the time of your death, as long as the spouse you had when you retired was still an eligible dependent, then your spouse would continue to get health insurance for as long as his or her eligibility status remained. Now, referring back to our illustration, you can see that by electing the 50% spouse option, the retiree's benefit has been reduced. Instead of getting $4,270 a month based on the age that the retiree was closest to and the age, in this case, the spouse was closest to, the benefit has been permanently reduced. And so from day one, the retiree would receive $4,155 a month. And at the time of the retiree's death, if the spouse was still alive, they would start receiving half of that amount. The next option we're going to discuss is the 50 or 100% survivor option. This is also referred to as the contingent annuitant option. And that is just a fancy word to say you can give any one person your benefit. You're not limited to a spouse or even a family member. You can name a niece or a nephew, a son or a daughter, even your neighbor if you wish to do so. Just remember, that if you've been married for at least a year, you will need your spouse to sign the spouse waiver form. If you elect option B, the 50 or 100% option, you must also choose at the time of retirement whether you're electing it to be a 50 or 100% option. The 50% option worked exactly the same way as the 50% option we discussed previously. Your benefit would be reduced. The reduction is based on the age you and your optionee are closest to when you retire. What I want to do now is draw your attention to the fact that there is a 100% option. Under the 100% option, your benefit would be reduced even more from day one to provide that at the time of your death, 100% of the payment you were receiving would continue to be paid at the same amount to the person you named at retirement as your contingent annuitant. So while this option costs you more money from day one, it also is the option that provides the highest level of monetary protection to one person after your death. There is an important note I want to make, is that if you elect this 100% option for a non-spouse and that person is 10 or more years younger than you, there is an IRS rule that would limit the amount that we could pay them after your death. So while they would still receive a benefit that would be higher than the 50% option, their payment would be less than 100% of your benefit, depending on their age at the time you retire. Health insurance follows the same rules as previously discussed. You can continue to cover your dependents while you're alive and as long as they meet the health eligibility rules. Health insurance would also continue after your death to the person you named as long as the contingent annuitant under this option met the health eligibility rules and they continue to be met. You can see in the illustration that we keep referring back to, under the 100% contingent annuitant option, the benefit has been reduced even further. But you could also see that at the time of the retiree's death, the survivor would continue to receive the exact same amount the retiree was getting previously. The next option we're going to discuss is option C, the 10 and 20-year period certain. The 10 and 20-year period certain work the same way. The only difference is the period of time the protection is being made. So let me explain how a 10-year period certain works. Under the 10-year period certain, your benefit would be reduced. The reduction is based entirely on the age you were closest to at retirement. We will pay you, the retiree, the reduced amount for your entire lifetime. At the time of your death, we're going to review just how long we were paying benefits to make sure that we fulfilled our commitment to pay a minimum of 10 years worth of payments. See, under this option, the retirement division is making a promise. We promise to pay a benefit for a minimum of 10 years. Therefore, if you were to pass away before the 10th anniversary of your retirement, the remaining payments would then be paid to your contingent annuitant or annuitants that you have named. For example, if you elect a 10-year period as certain and you passed away 6 years into your retirement, there would still be 4 years of payments left the retirement division must continue to pay. The remaining 4 years of payments would then be paid to whomever you identified as a contingent annuitant. Of course, I've never met a retiree who only wanted to live 10 years into retirement. So what happens if you, the retiree, live beyond the 10 years? Well, as previously stated, this entire discussion we're having is regarding how your elections affect your survivors. Again, you, the retiree, get a benefit for your lifetime. So if you elect a 10-year period as certain, and you live 30 years into retirement, we'll still pay you for the 30 years that you're alive. By the time of your death, if you elect a 10-year period as certain and live 30 years, since the retirement division has met its promise, we'd have no obligation to pay benefits to anyone else. So while payments will continue to be paid to you, the retiree, no one else will get paid under option C unless you pass away before the period of time expired, and then your contingents would only receive payments for the remaining period of time. The 20-year period certain works the same way, it's just a longer period of time that we're protecting. Health insurance follows the same rules we previously discussed. You, the retiree, can provide health insurance to your eligible dependents for as long as benefit is being paid and they continue to meet health insurance eligibility requirements. By the time of your death, health insurance would continue only for as long as payments are being paid. Once payments stop, health insurance stops as well. Eligible dependents would be offered COBRA for a limited period of time. And while I'm trying not to do so, I think this is an opportunity where we complicate things a little bit more, because it's important that we point out the following. Option C is the only option where you can name more than one contingent annuitant. While in the previous options, option A and B, you can only name one person, and benefits were based on both your age and their age as well. Under option C, it gets a little simpler. Because under option C, we're making a promise to pay benefits for a predefined period of time, the minimum of 10 or 20 years. Therefore, you can name more than one person. If you name more than one person, then the monthly benefits paid after your death are divided equally among those who you named. Last, if any of your contingent annuitants were to die before you, and there was still time left under this option, at that time you could name someone else to receive that annuitant's share. This is very unique to this option only. Under option A and option B, you can never change the option, even if the annuitant were to die before you. It's also important that under option C, changing the annuitant is limited to their death. For example, you can't change your annuitant because you had a fight or an argument and no longer want that person to get benefits. There's just no provision to allow a member to change an option for any reason under option C, except if the annuitant were to pass away before you. Going back to our illustration page, you can see even under the 10-year period certain, the benefit has been reduced from the original straight life annuity option. And if the person elects a 20-year period certain, the benefit is also adjusted to reflect that the person is guaranteeing payments will be paid for a minimum of 20 years. The next thing we would like to discuss is the pre-retirement death benefit. The pre-retirement death benefit says that if you die while you're actively employed or if you're on approved leave of absence, as long as you've been married for at least a year immediately before your death, your spouse would receive a monthly pre-retirement death benefit. You wouldn't have to fill any paperwork out at all, as long as at the time of your death you were eligible for an early, normal, or hazardous duty retirement, or you had 25 years of service at any age. Another provision we would like to discuss is called the 90-day window protection clause. Under the 90-day window protection clause, if you elect option B or option C, The law protects that choice for 90 calendar days after your election or up to the retirement date, whichever is earlier. However, this is a one-time protection. Therefore, you should not sign retirement paperwork until you're within 90 calendar days of your retirement date. Again, you can't go to Human Resources every 90 days to fill paperwork out. That's not the intention here. What the intention here is that if you are going to retire, you're going through the paperwork, and then you pass away before your retirement date, as long as the paperwork is not more than 90 days old and you never filled paperwork out before, we're going to honor this option. And we've seen this happen a lot with disability retirements, where an individual may have got some information that they have terminal illness and they don't live to the retirement date, but because they started the process to retire and they completed the paperwork, we were allowed to honor the options that they chose, even though they didn't live to their retirement date. The last point we like to make again is the health insurance. If you retire and you qualify for health insurance with your retirement, as long as you're receiving a monthly benefit, you will continue to be able to provide health insurance to your eligible dependents. However, your eligible dependents will not receive health insurance after your death unless you continued money to be paid after your death to your eligible dependent. Now's a good time to talk about some miscellaneous information. The first thing we're going to talk about is group life insurance. If you have the state's group life insurance policy, at retirement it will convert to a paid-up policy where you don't have to pay another dime. If you retire with at least 25 years of actual state service, or if you retire under a hazardous duty retirement, your survivors will receive a paid-up policy worth half the original amount at the time of your death. If you have less than 25 years, or if you worked a part-time schedule, the paid-up policy is prorated to reflect the schedule that you worked. You do have the option to convert your policy back to the original amount without evidence of insurability during the first 31 days of your retirement, but at an additional cost. When you retire, you will get information from our life insurance unit mailed to you advising you of this option. Some people may find it beneficial to convert their policy during the first 31 days, while some people may find private plans that work better for their financial situation. But again, if you do nothing and you pay nothing after retirement, the good news is that either half or the prorated amount will be paid to your designated survivors at the time of your death. I want to take a moment to talk about deferred compensation. Some of you, while you're actively employed, may have participated in deferred comp. It's important to note that when you retire, you will not be able to take any money from your retirement check to put into deferred comp. IRS regulations do not allow that. However, if you did participate in deferred comp, you may want to talk to a deferred comp carrier at the time of this presentation that was prudential, because there's things you could do with those monies down the road. Some of you may also have large payouts coming to you and may want to roll some of that money into your deferred comp. Now, there are limitations on how much money can be deferred each calendar year. Again, these are all questions that you'd want to talk to at this time Prudential to get that information. Taxes. Everything we've been discussing today is prior to taxes. Our estimators show you gross benefits before taxes and other deductions. As a retiree, you will pay federal tax, and whether you pay state tax will depend on the state you live in as a retiree. Among the paperwork your agency will give you to complete are tax forms. We rely on you to tell us what you want withheld for taxes. If you're staying in Connecticut, we recommend you complete the state tax form because if you do not, we're required to withhold a default rate of 6.9%. If you live out of state and that state has income tax, we will not be able to withhold that for you. Instead, you will need to find and work with that state to pay your income taxes separately. Lastly, while you are actively employed, you may have noticed you are paying Medicare and Social Security taxes each pay period, but in retirement, you will not pay those. In fact, the most common deductions state employees have in their pension checks are federal tax, state tax if you're living in Connecticut, dental if you're enrolled in that, and health insurance depending on the choices you have made. When you decide to retire, the first thing you want to do is let your agency know, and you want to give your agency 16 to 90 days notice so that they can prepare the paperwork for you. You want to send a letter to your human resources or payroll, a letter to your supervisor, and keep a copy for yourself. When you retire, you're going to have to provide some documentation, specifically your birth certificate. If you're taking an option for someone, their birth certificate, And if you're married, a copy of your marriage certificate. We do not need official stamps or seals. Photocopies are just fine. Your agency will have the additional forms for you to fill out with your retirement. When you leave state service, you're also going to get a payout of accrued time you may have left on the books. You'll get a payout of all your vacation time up to the maximum that your union contract allows. You will get paid a quarter of your sick leave balance to a maximum payout of 60 days. And if you still get longevities, you'll get one final longevity payment. Now, if your retirement date was April or October, the months that typically you would receive a full longevity check, you would continue to do so if your retirement date is April or October. But if you left a different month, say you left in May, you would receive a prorated longevity for the 1 month you've worked towards the full longevity you would have received if you continue to work past May to the October longevity date. And then that's the last longevity you would receive after your retirement. Let's discuss how retirement benefits are paid. Retirement checks are paid once a month at the end of the month. You either will receive a paper check, or if we have direct deposit information for you, you'll receive a direct deposit. For those members who receive direct deposit, instead of getting an advice each month, we will send you an advice twice a year, one in January and one in July. It's important to note that when you come onto our payroll, you're going to have to reapply for some of your monthly deductions. So if you had deductions for charitable giving, for example, you'd have to reapply for that. Other deductions some people may have would be retiree unions or credit unions that you would participate in. It's important to note that those are really the only deductions that we're limited to. Some people may have other things that they've applied to over the years through their agency, such as MetLife Auto and Home or a separate life insurance policy. It's important to note that our payroll is not set up to give those payments out, and so you'll have to talk to those companies to find new ways to make those payments each month. The audit process. Once you've completed your paperwork with your agency, they will send it along with your necessary personnel records to the retirement audit unit. As we mentioned earlier, the information you receive from our office is an estimate and assumes the information in our systems are accurate. The retirement auditors will calculate your actual retirement benefit and, if necessary, use information from your agency to correct the data in our systems. They will pay you your preliminary benefit, which you will receive on the last working day of your retirement date. The law limits retirement dates to the first of the month, so let's use an example. Say your retirement was the July 1st. Well, in that particular case, your last working day was June 30th. July 1st, you're retired. Don't show up to work that day. As you know, we are on a 2-week payroll cycle. So during the month of July, all the paychecks that were still in the pipeline from your agency will be paid to you, including the last paycheck from your agency, which will have any accruals that are due to be paid. The last check you'll receive that month will be your first pension check, and it's called the preliminary benefit calculated by our retirement auditors. You'll be paid your preliminary benefit until the auditors have a chance to go back through your record a second time to calculate your permanent benefit update, making sure that nothing was missed, and to add in any pensionable payouts that were still in the pipeline when they were doing their initial calculations. Now, the legislature built in a 6-month window for us to do that, and if it takes them more than 6 months, then they pay you 5% interest on whatever we're withholding after that 6-month period. I'm happy to report that we've eliminated most of our backlogs, so as long as your case is relatively straightforward, you should expect to have your permanent benefit update within the initial 6-month window. It is important to note that there are a few pension limitations we should discuss. First, there are 2 IRS or Internal Revenue Code limitations we should discuss. The first one is Section 401A, the compensation limit. How that works is that when we determine each of those 12-month periods for your average salary, there is a maximum amount that's allowed by IRS provisions for that year. Some of the most recent years are the $275,000 and $280,000 range. If your earnings for that calendar year exceeded that amount, then we'd be limiting your compensation to that when we calculate your average salary. The next limitation we should discuss is the Internal Revenue Code Section 415 benefit limit. And how this works is that the IRS has a limitation of what the monthly benefit can be received depending on a person's age at retirement. And there's more information on our website with regards to this. Let's also discuss any limitations that could occur if you get reemployed after retirement. After you've retired, if you find retirement life isn't for you and you want to get another job, you can do so. If you get a job with a Connecticut state agency, as long as it's temporary employment and you don't work more than 120 days in a calendar year, then you can continue to receive your retirement check and the money you're receiving as a temporary employee without any impact on your retirement. Some of you may also find that dream job you wanted in state government after you retired and decide to get permanent employment. That is, you applied for that job, you got hired, and now that agency wants to take you back full time. You can just let us know. We'll stop your pension. You go back in the retirement plan you had, and you retire again in the future under either the hazardous or non-hazardous duty retirement provisions. If you had already met the requirements for hazardous duty, for example, you'd retire under hazardous duty again in the future with the additional service added on. Now, if you get a job that's not with a Connecticut state agency, then we have no limitation at all. You can earn however much you want without impacting your retirement. Next limitation we'd like to talk about is 5142A. It's a special type of workers' comp, and we just like to remind people of this as well. This is a special type of workers' comp called 5142A. While a person is getting 5142A, they're continuing to accrue retirement credit. Also, by law, they cannot receive a retirement benefit and this at the same time. We're only driving your attention to it so that if the event that you have a re-aggravation of your injury after you retire and this workers' comp payment starts being paid, please give us a call so we can make sure that an overpayment is not being generated. For those of you who wish to do an estimate of what your benefit would be when you retire, we have a very helpful retirement estimator on the Comptroller's website. On our website, we have retirement information for all the different retirement plans and tiers. I'd like to draw your attention to the hazardous duty section. Under this section, we have our traditional workshop on the web, and we have a link where you can estimate your own benefit. If you clicked on the estimate your own benefit, you'll be brought to this screen. It's an input screen. This is where you would need to input your own information to calculate your retirement. You put in your date of birth, the date of your survivor's date of birth if you want to see what survivor option numbers would be. You would type in what you expect to have as an average salary, when you plan on retiring, and how many years of service you'll have at that time. With that information, you would receive an estimate that tells you what your benefit would be, how many years of service, and how it equates to a monetary benefit. It would also provide you the traditional survivor options. This is a very helpful tool, especially if you're trying to determine what your benefit would be under the different survivor options. If you qualify for continued health benefits, you'll be given the opportunity to elect health benefit options when completing your retirement paperwork. As a retiree, you're provided the same medical, dental, and prescription benefit plan cover options that you had as an active employee, the only difference being the cost of coverage deducted from your pension check. Once enrolled, you are not locked into the benefit plan option you selected when you retired. You may switch plans or add or drop dependents each year during the annual open enrollment or following a family status change, just as you can today. It's important to note that if you or one of your eligible enrolled dependents becomes eligible for Medicare, you must enroll in Medicare's Part A and B as soon as you're able to do so. You are generally eligible for Medicare when you turn age 65, but may be eligible sooner if you're permanently disabled. Once enrolled in Medicare, you must provide the retiree health insurance unit with a copy of a Medicare ID card in order to avoid a gap in coverage. You'll be automatically enrolled in the state's custom Medicare Advantage plan and will be eligible for reimbursement of your Medicare premiums. It's important not to be enrolled in any other Medicare plan as it could disrupt your state benefits. One last item to consider regarding health benefits after retirement is your selected survivor option. We've previously discussed your options for continued payment benefits after you should pass. Health benefit eligibility follows that payment. So as long as a payment continues to be paid to an eligible dependent, the health benefits will continue with it. When the survivor option payment ceases, so will the health benefit. Your selected survivor option may continue the health insurance benefits so long as they would be eligible to be enrolled under the coverage with you. For more information, including the current cost for retiree health coverage, benefit plan options, and Medicare details, please visit the state's specific Healthcare Compass website available at carecompass.ct.gov/retirees. There are additional sources of information I'd like to draw your attention to that would also be able to assist you in your retirement planning. As I mentioned previously, our comptroller's website has not only the workshops that are verbatim what we talked about in this presentation, but we also have benefit estimators and summary plan descriptions, and, as I mentioned, the retiree health insurance planner. These are also information you may be able to find in Social Security, Department of Revenue Services, the IRS, and if you participate in the deferred compensation program, Prudential would be a great place for you to go to get information on what you can do with those monies down the road. This concludes our hazard duty workshop. Now I know we covered a lot of information in this workshop, and I'd like to encourage you to also visit our website. On our website, we have our workshops on the web, which is almost verbatim everything I covered in this presentation. So my hope is that with this video and the information on our website, you'll get the answers to the majority of the retirement questions you may have. Now, on behalf of the Retirement Services Division, I want to congratulate you on your future retirement and have a nice day.